With an S Corp, not only can a shareholder in an S Corp receive wages and needs to receive wages from their company, they can also pull cash out of that company in the form of draw. So a lot of confusion can be around draws, and I'll address that. So with an S Corp, you are taxed on your net income. So your revenue that comes into your business, your expenses that go out of your business, including the payroll expense, those are deductions to the business, and they do affect your net income, which lands on the K-1 and is taxable to you personally. If you're taking money out of your S corporation as a draw, in other words, not through payroll, you're just pulling funds out, taking a dividend, for example, for yourself, that has no tax consequence. It can be kind of confusing because you expect if you're pulling funds from your business over to your personal, that's going to be taxable. It's actually not. So you're taxed on your net income, whether you leave that cash in your S Corp bank account or you pull it out as a personal draw and put it in your personal bank account. That movement of cash from one entity to the other is not a taxable event on either side of the equation. So a lot of times I'll have business owners come to me and they're like, I really want to pull money from my business, but I don't want to get taxed on it. Well, pull away, my friends, because that is not a taxable event. The same with a partnership. Partners in partnerships don't receive wages, but they do take draws from the business. And again, the act of moving funds from your business over to a personal is not a taxable event. You're going to be paying tax on your net income, and draws from the business do not affect your net income.